Hi friends, Simit here from InformedTrades.com. In today's video, I want to talk a little bit about deflation, what that is, and some opportunities it sets up for investors and speculators. Let's get started. Okay, key points. The concept of deflation is a US dollar-centric viewpoint. So actually from this perspective, other nations could experience inflation, actually hyperinflation as a result of capital leaving the country. So it's really from the perspective of the dollar that we're seeing deflation and the idea that prices are going to be falling, that the economies are sort of going to be, there's a downward spiral of sorts in prices. Other nations could see prices increase. Really what the idea of deflation is about global contraction, so the economies are getting smaller, growth rates are getting slower, especially outside the U.S., and a lot of this is related to debt levels and the price of debt and debt hindering the ability of economies to grow, as we'll see. So as economic opportunities are declining around the world, that leads to a flight to safety, and the flight to safety is the U.S. dollar, as we will see through some charts. And this is potentially a trend that could last for years, so definitely for those with a long-term outlook, this idea, this big picture perspective of whether deflation is occurring is something to pay attention to. It could shape your long-term view, as well as present any opportunities and long-term trends that you want to be a part of. Okay, I think one of the biggest stories, and for those who really believe in deflation, one of the pieces of evidence they'll cite the most is the situation with emerging market debt. So a lot of smaller countries, the debt around the world, we're seeing a huge increase in those debt levels. If you see this here, emerging market corporate debt, big increase. U.S. corporate debt has increased a lot as well, and we are seeing U.S. corporate debt interest rates for U.S. corporate debt is starting to rise, which means the bond prices are going lower. We're seeing that, especially the most pointed area where we're seeing that is in emerging markets, but we are seeing that in the U.S. as well. And here is the next chart. So this right here is the difference, this red line especially, the difference between U.S. emerging market debt and U.S. debt, corporate debt. Emerging market corporate debt and U.S. corporate debt. And we can see this red line, there's been a big spike up in 2014. So that signals that the emerging markets that investors are more wary, more concerned. They need a higher interest rate if they're going to buy emerging market debt. And because they need a higher interest rate, those bond prices are falling, they're kind of withdrawing from that. So there's the issue of, if they raise interest rates, then investors or corporations have difficulty raising debt because they now have to pay a higher interest rate for it. As well as bond investors, the investors are more wary. They're viewing it as a risk, and they need to be compensated for that risk, which is why they want a higher interest rate. And the businesses, higher interest rate can hinder their ability to raise capital. It's more expensive for them, so they have less capital to fuel their operations. So that's how you sort of see a decline in emerging markets, where their ability to grow is hindered in a way by this interest rate. And we're already seeing that. Okay, so as emerging markets are having difficulty growing, that is contributing to falling commodity prices. Definitely, we've seen on the chart right now, you see the candlestick line here. This is a year-to-date chart. We're seeing the fall of oil. We've talked a lot about that huge fall, one of the biggest stories of 2014. But we've also seen a decline in natural gas, this brown line, down 23% year-to-date, and copper down 15%, almost 15% year-to-date. And these are prices in dollars, right? So, and that's one of the things we won't talk about too much really in this video. We won't illustrate it. But other currencies have gone down in value, and have gone down in value even more than some of these commodities. Because what's happening is, as investors are not buying corporate debt in emerging markets, they're also just taking their money out of the country in general. So they're selling these emerging market currencies and buying other currencies, namely the US dollar. So when you sell a currency, its price goes down. The commodity prices, from the perspective of a person living in that country, the price of everything is actually going up. However, the currency value is declining, and the commodities are declining as well. So as I mentioned in the beginning, in the first slide, really this is from the idea of falling prices and the dollar rallying is really the perspective of the United States, or from the perspective of U.S. Dollar holders. Capital flees to the dollar. So we've seen capital demanding higher interest rates from emerging markets. That hinders emerging markets' ability to grow. That hinders commodity prices, right? Less demand for commodities since these companies don't have the ability to grow. So that's less demand for commodities, less demand for emerging market debt. All this capital is now fleeing to the U.S. dollar. And we've seen that this year. This is another year-to-date chart really since the middle of the year, since July, the US dollar has really soared. We've gone from under 80 on the dollar index to now closing in on 90. Now, technically, this is personally a major level I'm watching. Right here, this is a monthly chart, and this is actually going back quite far. Well, you actually don't see what's off the chart here, but here's a trend line at right around the turn of the millennium, and actually goes back to 1985, so it goes back even further. And we're at a possibility, so going back 30 years, of breaking that 30-year trend line. We'll see how this month closes, but if we close above 89, really, that 30-year trend line will be broken. And then, where does it pave the way to? Maybe we'll move to 102, we'll move to 119. So this could be a real long-term trend, a self-reinforcing spiral of emerging markets, capital fleeing from them, commodity prices, capital, less demand for that, and that cycle just keeps going and going, and it could lead to a much stronger dollar in the years to come. At least that is one viewpoint. There's also a viewpoint that dollar strength cannot last, and we'll discuss it. We've discussed that a whole bunch on Informed Trades. We'll discuss that probably in a future video as well. Hopefully this illustrates just some of the basic ideas of the concept of deflation, what it means, some trade ideas. Definitely, I'm personally long dollar yen in particular. So it does set up an idea. If you want to speculate on something for a few years with a little bit of your capital, there are some opportunities to give you some ideas. Any questions you have, anything you want to add, join us at informedtrades.com. Best of luck in your trading, and we'll see you next time. Take care.